Today, I sat down with Robert of Inspired Vision Accounting, and we discussed all things 1031 exchanges, as well as the role and importance a CPA has in a 1031 exchange transaction. So Rob, please help us determine what is the accountant's role in a 1031 exchange?
You know, our role is really, we serve a number of roles really throughout the whole process. Mm-hmm. But, first off, it's education, right? Because a lot of clients, they come to us and they'll say, oh, I was thinking about doing a 1031 exchange because I don't want to pay taxes. Not fully understanding what exactly that all means, right? The biggest thing that I tell people about, the timing constraints and, we got to really cross a T and dot an I. And so that's the first step of it, right? Just, I want to do a 1031 exchange. Well, let's explain what that actually means. Right. And then after that, it's really just, compliance, making sure they're doing everything right. I had a client who said, I'm going to have my dad be the qualified intermediary. And I'm like, well, does he do this,
Right, yeah.
Oh, no, he's just going to hold on to the money for me, just so, but I'm like, let's get a professional, make sure that we're doing it all right. So, and then also to an extent, making sure that all the parties involved, right? Do they have a real estate attorney that's, familiar with this process? Because everybody, it's just a little different from the standard, closing that you would when you sell a house.
But, I think you can see too, it's also discussing with them, does it really make sense for them overall in their picture, right?
Totally.
Understanding their numbers, and does that tax gain that they might have, or possibly even a loss, does it truly make sense to do a 1031? That's one of the things that they always come to us is, does this make sense? And hey, I can only talk to you on a high level overview of your tax picture, but you need to really discuss with the CPA, because there might be other factors in your tax picture that we don't know that can cause something different altogether for you, where it might not even make sense.
That's a great point. Like I had a situation where a client comes to me and says, okay, well, I got this big gain on this property. I want to do a 1031 exchange. And so, we sit down and we crunch the numbers, and I'm like, well, wait a second. You had passive losses on this rental for a whole bunch of years that aren't going to be released until we sell the property. So when I sit down and I figure it out, yeah, you had a $200,000 capital gain, but we had passive losses of $170,000 that are going to be released here. So we're really only talking about $30,000 of income. Is this still a candidate property? Especially, hey, I got laid off, this year. My income is super low this year. Okay, well, if that's the case, then let's maybe consider paying our taxes now, because, we want to have a holistic, view of everything. And that is the biggest thing that I have to remind people about 1031s. It's deferral. It's not an elimination. It can be, but it's not immediately an elimination of taxes.
Yeah, they kind of forget that, and they think, oh, I don't have to pay taxes. No, you don't have to pay taxes now. You might have to pay it later, depending on what you do later, or what happens later from that end. So yeah, no, it's a great point. So you mentioned about, in a little bit ago about this the investor wanting to have his dad be his qualified intermediary. So there's what we see a lot of these misconceptions that come out. What other kind of misconceptions do they come to you when they're like, oh, can I do a 1031? And then whether it's after they talk to you or they talk to us, they come back to you and say, I didn't know this, or along those lines there.
Yeah, first and foremost, all the time, folks come to me and say, hey, we're selling our primary home. I want to do a 1031. And so just having to clarify that for them. Now, there's also Section 121, which allows you to eliminate a component.
It's an exemption, not a deferral, so that usually is a lot more better in that case.
Yeah, let's definitely use that if that's available to you. So that's one very common one. Unfortunately, it's happened quite a few times where a client will come to me in March, and when we're doing their taxes and saying, hey, I sold this property, but I want to do a 1031 on it. And it's like, well,
a little bit too late.
That ship has sailed.
Yeah.
So, so really, really important to bring all the parties involved on day one. Make sure you're not making any missteps, because there are things that, if not done early on, can make the process null and void.
I think, and talking about misconceptions, one thing that comes up, and we always have them obviously defer back to their CPA or their tax advisor, is, well, if it was a vacation home or a second home. And, and from our end, those don't qualify unless the usage, we have to look at the usage. And so we're always sending them, over to the CPA because they don't even know, has it been reported as a second home or a vacation home over the years, or has it truly been reported as an investment property? Do you see a lot of clients coming up with those?
Definitely with that. And there are folks who, try and get creative and, hey, that beach house that I had that I never rented out, I bought it because it was a deal. And maybe that for an investment play down the line. So is that an investment property or is that a second home? Well, you used it, majority of the time with your family. So, we always have to look at all the facts and circumstances and see if we can.
We know the audit's always going to come back and say, okay, over the years, one of the easiest ways is depreciation, right? Have you been taking, obviously you can't depreciate a second home or vacation home. So you have that backup there to help determine, yes, we're fine with that because we've been treating it as an investment property over the years, whether it was generating income or not. We knew, and you've limited that personal use to it.
And that's always what I tell clients is at the end of the day, at the other side of the table, well, we don't do audits in person anymore, but when we did do them, that's another just a human, right? So they're gonna have a lens of it and say, okay, does this make sense? Does this narrative, align with what this person is telling me that is their tax situation? So, I never, encourage folks to get creative, but a lot of times these are large gains that folks are looking at, and therefore large tax bills. So, there is motivation to use some of these options.
It's good stuff there. So other things people come to us, and I think we touched a little bit on it, is they think it's just capital gains. They don't realize too you're also deferring depreciation recapture tax as well. Talk to us a little bit about depreciation recapture, how that plays into someone who has an investment property and looks to sell it, whether they even taken depreciation. I don't know how many times I hear, oh, I didn't take it, but I believe, I still believe the IRS can still tax you on that depreciation recapture whether you took it or not.
Absolutely. The tax code, the way the code reads, and this isn't verbatim by any means, but it's the depreciation claimed or available to have been claimed. So that's the worst case scenario. You didn't get that depreciation deduction all those years, but now we have to recapture it. So obviously on a high level, the concept of depreciation is you get a deduction for each year for the decrease in the value of the real property. So it's a tax deduction. That's you're not writing a check for depreciation, right? So it's kind of the best part of real estate.
Benefit, right? The benefit that they give you to take.
Yeah. So now on the flip side, and this happens, outside of the 1031 scheme as well, where clients will tell me, okay, well, I sold this investment property. I sold it for $500,000. I bought it for $400,000. So I have $100,000 of capital gains. But what about the $150,000 or whatever of depreciation that we've claimed over the life of you having that asset?
Right.
And now that becomes taxable income. Taxable at ordinary income rates, which most people, assume it's capital gains, which could be beneficial. So up to a maximum rate of 25%. Right. So that is the one thing that a lot of folks tend to forget about when they're figuring out their capital gain, or even, I say the importance of getting involved with a team of professionals early on, because we really want to sit down and crunch the numbers. And say, okay, well, what really are we dealing with here?
Right.
A lot of folks come to me and say, oh, I sold the property for $500,000, but I had a mortgage on it, $450,000. So, well, that's not in 1031. That's important, but from the capital gains perspective, they're looking at your proceeds and your cost basis, adjusted cost basis.
Right. They forget that they still got the cash that had to pay off that mortgage, so
right.
that comes into play. So even though they didn't see it, still goes. Debt relief is taxable, right, or along those lines. So so especially the debt component in the 1031, replacing the value of the debt that people completely forget about, or they try to overextend the debt more on the new property, realizing they have more cash in pocket, creating a cash boot situation.
Right.
It's one of the things we always are looking at for them and trying to determine, along those lines there. So so from your experience, any pitfalls that investors should look at while contemplating a 1031 exchange, especially from an accountant's perspective, whether it's even possibilities of some of the scenarios that can occur if things cross years, right? We see a lot of tax scenarios or strategies that come into play at the end of the year and how people can kind of leverage cross years in that regard.
Yeah. Most of the pitfalls that we really see are, once again, I'm going to sound like a broken record, just getting a team involved early on. Because honestly, I got to tell you, when you have, the professionals in play, there's not so many things that can really go wrong. Of course, there's always, property we identified is no longer available, or something happens, with the timing wise, and we try and the importance of planning ahead. I always have a plan A, a B, a C. We want to have.
What's going to happen if this doesn't happen? How do we then minimize that capital gain tax hit later or something like that can come up?
Absolutely.
And surprisingly too, of how many people, and I'm sure, like we said, like you mentioned earlier, we always say start early. Start before you sell, not after you sell, because we know you don't find a lot of things out until it's after the fact. Like, hey, I just did this. What's my tax consequence? Like, well, now you're like this, but we could have done this. Did you think about this? That's the whole point of having us available, is to minimize that aspect that comes through.
Absolutely. And like, I've even had people say, oh, well, once my property sells and I figure that part out, then I'll move on to the next piece. And it's like, granted, you may be redoing all of that work again because of, the factors that changed. But it's important to get started early enough, because once again, you're reducing the likelihood of the surprises.
Right.
But the pitfalls we see, of course, are, like I said, really not planning ahead.
Maybe not understanding the timeline, how long they have to get something done.
The 45, 180,
And one thing I think we always see too is, and hopefully they come and talk to you, is, how do they currently holding title, and how is it currently being reported? Because we see a lot, husband and wife, things want to go separate ways, or they're in a corporation, or they're, in an LLC. Yeah. Whether it's single member or multi-member. So talk to us a little bit about how that, because from our end, we always have to, continuity of taxpayers is huge for the 1031. Of course. But when you have partners involved and they want to go separate ways, obviously there's strategies in play that we can put in, but we always want them to obviously talk, because I know there's probably other aspects that people have to look at from a partnership standpoint to make sure it truly, can we get out of this partnership so that I can go my way, he could go his way. Yeah,
definitely. When multiple parties are involved, the complexity, it's not like two people twice the trouble. It's right. 4 times, right? It's always getting everybody on the same page, everybody in agreement, and honestly, a lot of the time we do see kind of differences of opinion in which way we want to go lead to problems, and whether that be more often my situation that I see more often than not is like, inherited property split between brother and sister, right. And difference of opinion and who wants to do what. Somebody wants to sell and do a 1031 for their part, right? And that introduces a lot of complexity. So the candidates that we're looking at for 1031, it's really going to be like, simple, fee simple ownership, and husband and wife, right. or whatever. Hopefully not getting divorced, or if there was a divorce, the title was handled properly, because we see that all the time, right. As well. That does introduce problems.
So we kind of talk about those pitfalls, right? So what about on the other side of the spectrum, the success stories? Can you share a success story, whether it's someone going through a 1031, they inherited a property, if stepped up in basis came into play, from that end, any kind of success stories?
Well, so actually the other way around, we had we introduced the 1031 as a potential, because what had happened was mother had, a little bit of a real estate portfolio. She was ill. We knew that, her time was coming to an end, and there was complexities within the family dynamic. And so the mom wanted one of her daughters specifically to manage the portfolio. So she had gone ahead and transferred ownership before her passing. So we had no step up in cost basis available to us. And so we introduced the 1031 concept to the daughter, who now is the owner of the properties. And so where she was looking at, because she didn't want this particular property that, was a
right.
bigger one. But she was a real estate investor herself, and all of her properties were located in a geographic area, so she wanted to get in, and she was able to. So, so that was a pretty big win. She was basically resigned to just keeping this property forever, and then we came in with the 1031 idea, and we made a difference there. But on the flip side, the step up in cost basis, right? Anytime, like when we mentioned when we opened, right, 1031 is deferral of taxes. My hope is that it's an elimination.
Right.
Right.
How do we get to that point? Right.
Yeah. So, and that's what, and people always ask me, okay, well, I'm deferring the gain. What's going to happen after the next property sells? And my hope and belief and what I'm doing personally for myself is, just continue to 1031 until eventually I pass, right? And then my properties will be going to, in my case, my children.
Right.
And then they get a step up. So whatever the value of that property is on the date of my passing, that's now their cost basis. So now all of that deferred gain that we were, building up within these properties, now not a problem.
Yeah, we see that a lot, and when we're talking to clients about that, they're like, well, what happens later, right? And it's like we tell them, like, as it stands now, there's no rule saying how many you can do. It's one of those you can continue doing over the course of your lifetime, but utilize it too, make sure you have the right people, because it is an estate planning tool as well, understanding what can happen at the end of that scenario, or even then, as the estate planning tool, what happens if you do want to cash out? What are those tax consequences? How can you mitigate those tax consequences into other kind of investment vehicles or something like that? But really, it's an estate planning tool, and in that scenario with the daughter, you can see that with that stepped up in basis, it's building that generational wealth that we always talk about having that ability to create this wealth that you can now pass on to your heirs and your kids and their kids and so forth, and allow that to continue to grow. So
yeah, absolutely.
We see that.
And it's like, for me, when I look at these things from a tax perspective, I mean, the current tax code is very, very favorable for real estate investors, right? And yeah, of course, you can build a massive, investment portfolio in a brokerage account, let's say, but that's going to kick off tax implications each and every year.
Right.
Even when, in some cases, like I have clients who have, capital gains on mutual funds of, this past year I had a client at $70,000 of capital gains from his mutual funds, and why do I owe so much in taxes? And I said, well, this mutual fund did fairly well for you, and you have a large liability as a result. I didn't sell that mutual fund. Well, no, you didn't, but it's an active fund, and there's a lot of involvement in there, so it does, create some tax implications.
Right.
As opposed to people come to me and my rental property, I was able to increase my rent this year, so I was able to put a little bit more money in my pocket. I think I'm going to have to pay a little bit more in taxes as a result. Oh, well, actually, when we factor in the depreciation and the mortgage interest and all these kind of costs associated with that rental property, you actually don't have a taxable gain.
Right.
Really, really quite favorable. So in terms of building that generational wealth, real estate currently is a great vehicle to do that in a very tax efficient manner. So
yeah. What about across, one of the things, do you discuss clients as well, as far as, especially clients in states, obviously, even though the 1031 is on the federal level, the IRS, I believe all states do recognize it on their own way on the state level as well. So there also is a deferral on the state level, but we do see clients too, depending on what state they come through, a little bit of the clawback provisions and so forth.
Yeah.
So, do you discuss that with them as well, so they can kind of understand what's happening in those regards?
Of course.
California, Massachusetts, I believe, from that end. So
yeah, and that is the thing. As accountants, we by default we're always thinking federal, right? The IRS tax code and sometimes, we do tend to overlook some of the state tax implications. But there are states that don't recognize it. New Jersey, Pennsylvania does not recognize the 1031 in the way that the feds do. California, very, very interesting in terms of some of their provisions. So you mentioned the clawback, and that's,
right.
California is saying, if you do sell a property, later sell another property, because it's very convenient planning, right? You sell a property in California, 1031 it into Texas, let's say, and then sell that property, and then you won't have to pay any state income taxes.
Right.
California says, no, 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 we're going to claw back that. And on top of that, it is, you know, an annual reporting. So a lot of
Right.
people forget that, you know, from a compliance perspective, and it shouldn't be a big deal. It's a simple form. Any
Saying I
accountant,
still have it or I don't have it, and that's how they know
Yeah.
whether you did sell it or not
Yeah.
from that end.
but it's got to be done. You know,
Right.
one extra thing you got to remember now until that property is eventually sold. And like we mentioned, if that's never going to happen, then the rest of the year you're filing, you know, returns in an information return in California, you know, to help them track what the basis is.
No, all great stuff. You know, appreciate you taking the time to discuss, you know, both in your practice, you know, with your clients as well as just in whole, you know, from the CPA's perspective of that. You know, we truly appreciate the time, you know, coming in with that and, you know, seeing all sides of it, right? You know, we only know it from our end, but a CPA has a different look on things, and so that's why we're always saying, you know, always talk to your CPA and do it beforehand, right? You know, before you're going to sell, know what your tax consequence would be or could be, and see if it truly makes sense. You know, that's the big thing. We don't want people just to do it, but you know, it's got to make sense because there are the rules and restrictions that come into play, you know, and so forth, that funds could be used otherwise in that regard. So appreciate the time, Robert, coming out and discussing that with us.
My pleasure. Thank you for having me.
And with that being said, we hope you enjoyed our conversation. Please make sure to subscribe, and I hope to see you with our next video.